Every year in January, I have the chance to visit the CES trade show in Las Vegas, and there is one booth that stands out to me and that I always find very interesting. That is the booth of John Deere. I find it quite impressive what kind of technology they are developing and implementing in their machines to improve the efficiency, sustainability and connectivity of their customers. And the majority of these developments are also still quite new, as Deere only started their smart industry operating model in 2020. But not only are their machines impressive, the dividend track record also spans 34 years, and even though the company slowed the dividend increase during COVID temporarily, the average yearly dividend growth in the last 5 years has still been more than 14%. But there are dark clouds on the horizon for Deere. The forecast for next year is everything but rosy. So, should you invest in John Deere right now? In this video, I'll dig into the business models and the markets of John Deere, analyze the strategic position by doing a Porter's 5 forces analysis, and have a look at the latest financial statements to see how they are doing. I'll also check the valuation and do a discounted cash flow calculation to determine their fair value. In the end, we will see if John Deere is a good long-term investment for us or not. My name is Florian. Welcome to Cashflow Maniac. John Deere is listed under the ticker symbol DE on the New York Stock Exchange, and they are working in the industrial sector. They were founded 1837 and have more than 80,000 employees at the moment. Their headquarters is in Moline, Illinois, and their market cap sits at $106 billion at the moment. The performance of John Deere in the last year was everything but impressive. Currently, they are sitting at minus 6% on a year-over-year performance. That is lacking the S&P 500 by around 25%. When we look at the 5-year period, it looks a bit different. In this case, John Deere could outperform the S&P 500, but we can already see that most of this performance came in the time frame between 2020 to 2021. Since 2021, the stock has mostly traded sidewards. On a 5-year performance, we can also see that John Deere could outperform the S&P 500, but again, most of the returns came in this time period between 2020 and 2021. Most of you probably already know what John Deere is doing, but for completeness sake, let's very briefly sum it up. John Deere is the manufacturer of a diversified portfolio of industrial machines, mostly for the agriculture or construction industry. We can see they are divided into 4 main business models. One of them is production and precision agriculture. Second one is small agriculture and turf. And the third one is construction and forestry. Their 4th business segment, enabling businesses, is mostly about intelligence solutions like software or connectivity solutions, aftermarket, financials, and also power systems. And in all these business segments, John Deere is actually providing a plethora of different machines like tractors, harvesters, even special kind of harvesters like forage harvesters, cotton pickers, sugarcane harvesters, but also specialized machines like field sprayers or handlers or excavators for the construction equipment, track loader, graders. This actually includes most of the machines that you can find either on farms, construction sites, or in the forestry industry. They also have a couple of smaller products like snow throwers or snowmobiles, but also lawn mowers or so. And most of John Deere's machines, especially in the agriculture sector, are very distinguishable by their green and yellow paint job. When we go a bit deeper into the numbers of the net sales and revenue by product line, we can actually see that the agriculture sector makes up of around 60% of the whole business, followed by the construction industry, which makes up around 20%, and the rest is split between forestry, financial products, and other. In the geographic distribution, US and Canada make up more than 60% of the business, followed by Western Europe 13%, Latin America 13%, and the remaining 30% are split between Central Europe, Asia, Africa, and Australia. The growth numbers for all these regions look quite nice from 2022 gray bar to 2023 the green bar, and only in the Central European and CIS region did the sales decline on a year-over-year basis by just a little bit. It already seems like John Deere did really have a good year in 2023. But we'll come to the details of the financial situation later. In 2020, John Deere announced their new Smart Industrial Operating Model. In this operating model, they are focusing on 3 areas. First is production systems, 2 is technology stack, and 3 is lifecycle solutions. In the production systems, they are actually focusing on understanding the customer needs and trying to increase the operations and the productivity of their customers. In point number 3, lifecycle solutions, they are focusing more on the aftermarket and support capabilities and are also trying to bring add-on equipment or services for their machines so that the customers basically can upgrade their machines to be always up to date and to be compatible with the latest technology. The most interesting of these 3 areas I find is the technology stack. In this, John Deere is trying to leverage core technologies including digital capabilities like automation, autonomy, or alternative power technologies. So here they are really trying to drill down to unlock the economic and sustainable value for the customers by strengthening their decision making and better connecting every step of the whole process. To better understand this, let's head over to John Deere's homepage, and down here we can see the 4 core areas where John Deere is doing this development right now. First is the harnessing the power of alternative energy. That basically means that they are trying to electrify their machines and they expect to have the first fully electric machine by 2026. The second one is AI recognition. So this is very interesting. Here they are using a whole sensor suite, including 36 cameras, to really apply the herbicide to each weed individually and not apply the herbicide to the whole field and spray it all over the area. This is reducing the chemical use, which on one side saves the customer some money, but on the other hand, it also helps keeping the crop that they are planting healthy and without any herbicides. The third section here is autonomy, and here they are integrating also again sensor suites to their tractors, so they can basically do the job without any driver. You can see in the picture here we don't have any driver, and the tractor is basically working on the field without any human inside. The fourth sector here is connectivity, and with this they are trying to connect all their machines to the cloud, so the operators or the farmers can really see, first of all, the health of their machines, if they are working properly or not, but also the effectiveness of the whole fleet in one glance. So again, all these fields are really trying to optimize the processes of their customer and to help increase their efficiency. The market in their biggest sector, the agricultural machine market, is expected to increase until 2029 by 5.4% annually. So this is some nice growth, although it's nothing to write home about. In the construction equipment market, it looks actually similar. Here, the compounded annual growth rate until 2030 is a little bit higher than the agriculture market. Here we are sitting at 8.4%. We saw before that the US and Canada are the biggest markets for John Deere, and here the market growth rate is a bit slower compared to the global one with 7.1%. So again, it is some nice growth. We do have a secular trend here, but it's not that big. When we look at the strategic position of John Deere by doing the Porter's 5 forces analysis, first of all, I think the threat of new entrants is medium. Due to its size and the diversification of John Deere's business, it is very hard for our competitors to compete with them on all fronts. There are quite high capital requirements to enter this market, and the economy of scale and the good brand recognition of John Deere makes it really hard to compete with them. Although in smaller segments, there might be niche players more focused on this specific segment who can grab some market share due to technological advancements in this specific niche. The threat of substitutes I would estimate as medium to low. While there are alternatives to John Deere out there, the specialized nature of these agriculture and construction machines make it very hard to replace them one by one. Also, there is high investment necessary to purchase these machines, so it's not easy to replace them just every other year. The competitive rivalry, on the other hand, is quite high. There is severe competition in this market, at least amongst the major players here, and we also have quite a mature market here with numerous established players. But even though every company is trying to distinguish themselves from the competition by different features, by technological advancements, In the end, all of these machines are still very similar. John Deere's brand recognition and the extensive dealer network still give them quite a good advantage here. Also, their continuous commitment to innovation and technology gives them a slight edge against their competition. The bargaining power of their customers I would estimate as high to medium. The different manufacturers in these markets give the customers the choice. And for these expensive machines, it's also not uncommon to just lease them instead of purchasing them. But again, the brand recognition and also the technology and the features that John Deere can provide all over their whole portfolio still mitigate some of this bargaining power of their customers. The bargaining power of their suppliers, on the other hand, I would estimate as quite low. Most of the material that John Deere needs is commodity equipment like steel or plastic or rubber or so. And of course, this is affected by the commodity prices and also to some extent by the exchange rates. But in general, these materials are easily available from different suppliers, and here the size of John Deere gives them a favorable negotiation position. So overall, I think that the market that John Deere is operating in is highly competitive. There are numerous players. It's very difficult for anyone to stand out. But the diversification and the brand recognition of John Deere still gives them a slight moat here. If you do like the video so far, please consider leaving me a like or even subscribing to the channel. It would really help me out a lot. So let's have a look at the financial position of John Deere, and let's start by looking at the results of the last fiscal year 2023. And here we can already see in all of these areas that they had quite a significant increase compared to the fiscal year 2022. Net sales and revenue is up 16% on a year-over-year basis. Net sales again up 16% on a year-over-year basis. Net income up 43% and diluted earnings per share even up almost 50%. So in the last year, John Deere could really produce some extraordinary financial results. Unfortunately, they don't think that they can continue with this huge growth trend from last year, also in this year. And if you look at the first major segment, the agriculture and turf segment, if you remember before, this makes up around 60% of their revenue and sales. And basically in each region all over the world, they expect that this will decline on a mid-single to low double-digit basis. In the construction and forestry segment, it actually looks the same. Here we can also see that in most areas, John Deere expects an industry decline. And when we look at the income statement at Market Screener, we can see that they actually expect the same. Here we can see a huge growth trend over the last years, but in 2024, it is bound to decline again, and the growth after this is also expected to be much slower than what we had in the last years. What is nice to see here is that the net margin and the operating margin both also increased quite significantly over the last couple of years, and at least these margins are bound to stay on quite a high level also over the next years, even though the sales and the net income should decrease a bit. When we go down to the balance sheet, we can see the same trend for the EBITDA. EBITDA again increased until 2023, but from next year it should decrease, and the growth after this should also be much slower than what we had over the last years. What is very nice to see is that over the last couple of years, John Deere could actually clean up their balance sheet by quite a bit. You can see they went up from a leverage of more than 7 times debt to EBITDA up to around 4 times debt to EBITDA that we have as of today. So this is a very nice trend to see, and the balance sheet doesn't seem too leveraged at the moment. The revenue actually shows the same trend that we just saw for the net income and the operating profit. And here we can also see a nice increase over the last 10 years. But what we can also already see is that John Deere is quite a cyclical company. And over the last 10 years, we can see that it declined sometimes, then we had an increase again, then it declined again before it increased again, and now we will have a decline in the next year again. So it's not a very smooth and stable uptrend, but it's really more of an up and down with a general uptrend. The levered free cash flow, unfortunately, doesn't follow the same trend. John Deere does have significant free cash flow, but there is unfortunately no clear increase to see here. We'll come to the main reason for this later on, but First of all, I also wanted to have a look at the cash flow from operations here. And in this case, we can again see the cyclical nature of John Deere, but we can also see a general uptrend. So that basically means that the operational cash flow of John Deere generally increases, but it seems like they adjust their expenses somehow so that the free cash flow in the end stays roughly on a similar level. So to really understand where this fluctuation in free cash flow comes from, even though we just saw that the operating cash flow is generally increasing, we have to look at the use of cash priorities of John Deere. Here we can see first priority is actually to commit to an A rating. So that means managing the balance sheet so it's not too leveraged, including keeping high liquidity. The second priority actually is to invest the money back into their business to create more value to fund the growth the company needs. And especially R&D plays a huge role here to keep up with all these technological advancements. The third priority is actually to pay and moderately raise the dividend. And here it is very interesting that they are targeting a payout ratio of 25 to 35% of their earnings. Please keep this number in mind. You might be surprised when we see later on where John Deere currently sits with their payout ratio. And the last but not least priority is actually share repurchases. And here they state directly that they use this as a means to deploy excess cash to their shareholders. And over the last couple of years, they really used this to deploy a lot of excess cash to their shareholders. In fact, the CAGR of their share dilution over the last 5 years has been minus 2.5%. That is a lot of shares they repurchased in this time frame. So when we sum this up by using my checklist, first of all, we can see that the revenue growth over the last 5 years has been sitting at over 10%. So definitely green checkbox for me. The net income growth over the last 5 years has been sitting at 33.8%. So definitely also green checkbox for me. The free cash flow growth, on the other hand, we just saw that it's not really growing, but it's fluctuating on a year-over-year basis. And in fact, 5 years ago, the free cash flow has been negative, so we cannot calculate the free cash flow growth properly. So for this reason, this is first of all a yellow checkbox for me. If we look at the operating cash flow, on the other hand, we can see that John Deere had a CAGR over the last 5 years of over 40%. So when we look at the operations side of their business, they really can increase their cash flow. They are just returning all the cash they earn back to their shareholders, which in this case is basically good news for us. The free cash flow yield sits at 1.9%, which is lower than my threshold of 3%, so yellow checkbox again. The balance sheet of John Deere is not too leveraged, but with a 4x debt to EBITDA ratio, they are also sitting a little bit higher than my threshold of 3x debt to EBITDA. And even though they could lower this leverage in the last couple of years quite significantly, it is a little bit questionable to me if they can continue this trend also over the next years, when their sales and revenue is expected to decline actually. John Deere is a dividend payer. They are paying a small dividend yield of 1.5%. But over the last 5 years, they had a dividend growth CAGR of 14%, which is very nice to see. Their dividend payout ratio actually sits at a very, very low value of only 14%. And even if we include the business outlook for next year and the expectation that the sales and the revenue will decline, there is still a lot of room for them to grow the dividend until they even reach their target area. So over the next years, I would expect that John Deere still has a lot of room to keep growing the dividend with the same pace they did in the last years. They could also increase their margins and the return of invested capital on a year-over-year basis in the last 5 years. So this is also very nice to see and definitely green checkbox for me. Before we sum this up, let's also look at the valuation of John Deere to see if right now is a good time to invest in them or not. First of all, let's look at the PE ratio, here the orange line. And over the last 10 years, we can see that right now we are basically sitting at the lowest PE multiple that we had in this whole time frame. The same is actually true for the price to cash flow ratio. Again, we are sitting very close to the lowest levels we ever had in this 10-year time frame. And again, the same is true for the EV to EBITDA ratio. if we compare these values to the sector averages, they are actually almost on par with the average sector. But over the last years, you had to pay quite a premium for the stock of John Deere compared to their competitors. As a dividend payer, it is also always interesting for me to look at the dividend yield they had in this time frame. And again, in the time frame of the last 10 years, we can actually see that the dividend sits at quite a low level compared to the historical values. For my fair value calculation, I actually used my own assumptions this times. And my assumptions here are a mix between their 10-year CAGR rates and the analyst forecast for the next couple of years. So for the free cash flow growth rate, I assumed an average growth rate of 10% for the next 10 years. Net income growth rate, I assumed 7% for the next 10 years. And I also corrected the share dilution a bit down from the 2.5% that we just saw to only 1.5%, because I don't think that they can keep up this huge amount of share buybacks that they had over the last 5 years. And when we plug in these numbers, we come up with an average fair value of around $340 compared to the current stock price of 360. The average price here sits quite a bit lower compared to the value that we have as of today. And when including a margin of safety of 10%, it comes even down to $280. And for this assumption, I also use the price to free cash flow multiple 5-year average and the same for the PE multiple. So the current values are even sitting a bit lower. So if you correct this down to the rough values that we have as of today, we can see that the fair value even drops further down. Of course, especially the discounted cash flow calculation really depends on your input values. So I would definitely encourage you to do your own calculation, play around with the numbers a little bit and see with what kind of fair value you can come up with. John Deere is slowly approaching its 200-year anniversary. And during this time frame, they could reinvent and expand the business model a couple of times to stay relevant and up to date. This is no easy feat that not so many companies can accomplish, and with their smart industrial operation model, they are again trying to leverage the latest technologies to make the operation of their customers more efficient. And even though they are operating in a highly competitive market, their brand recognition and focus on technological advancements give them an edge against their competitors. The markets they are operating in are expected to grow on a mid-single-digit basis over the next years, driven by a growth in global population and higher food demand. And while they could beat their earnings expectations over the last couple of quarters, their outlook for this year looks a lot more bullish. And while the stock could outperform the S&P 500 in total over the last 5 years, investors didn't see much return after the big run-up in 2020 and 2021. Due to the weak outlook in 2024, I would also expect this sideways trend to continue at least over the next couple of months. John Deere did increase the dividends by more than 40% on a 5-year CAGR and 11% on a 10-year CAGR. And they did all this while still keeping the payout ratio below 15% of earnings. The valuation of John Deere also seems very reasonable compared to their historical values, even though the fair value that I came up with in my calculation seems a bit lower than the current stock price. So there is a lot to like about John Deere, and especially for dividend growth investors, it might really be worth considering an investment. What bothers me most about the stock is the cyclical nature of the business, which results in cyclical revenue and operating cash flow. And even though I do believe that John Deere has a moat, I don't think it's too big. I am currently not invested in John Deere, but for diversification's sake, I am actively looking to build 1 or 2 new positions specifically in the industrial sector this year, and I'll definitely consider John Deere for this. So if you did like the video and if you did find the analysis helpful, please leave me a like or subscribe to the channel. Also, if you're interested in statistical data for the stock market and the general economy, that really helps us to build our investing strategy and investing portfolio in general, please have a look at my video from last week, where I sum up the best insights from the JP Morgan Guide to the Market 2024. I'll put a link to it right here, or maybe here. That being said, thank you so much for watching, guys, and see you next week.